The House Insurance Committee will come to order. Clerk, will you please take attendance?
Chair Harris,
Here.
Representatives Tisdale,
Here.
Leitner,
Here.
Postuma,
Here.
Aragona,
Here.
Nair,
Here.
Judy,
Here.
Carter,
Here.
Tate,
Here.
Fitzgerald,
Here.
Woodsett. Mr. Chair, you have 10 members present, a quorum.
Thank you. And can I have a motion to approve the minutes from the April 16th meeting? And Vice Chair Carter makes that motion. And seeing no objections, the minutes are approved. First on the agenda today is testimony only for House Bill 4464, which happens to be one that I introduced. This is a very, very basic cleanup bill, addresses some technical issues to the insurance code and aims to codify some federal exemptions for specific types of health plans. And under the ACA, certain health plans were granted exemptions from specific rules and regulations. However, these exemptions were not incorporated into state law when aspects of the ACA were codified in the previous session. So this bill provides exemptions for the following types of plans: retiree-only plans, non-grandfathered plans, and fixed indemnity plans. And I'm happy to answer any questions you may have, and I got a little expert sitting in our audience just in case. So, committee have any questions on that bill? All right, we'll revisit this next week for a vote. So, thank you. All right, next item on our agenda is a presentation from the Institutes Griffith Foundation, and they're here to discuss life insurance, which I'm looking forward to learning a little bit more about. And you actually made me read my own policy, so in preparation for coming in. So we are joined by Frank Paul Tomasello, Executive Director of the Institutes Griffith Foundation, and Dr. Robert Klein, who's the Emeritus Professor of Risk Management and Insurance at Georgia State University. Gentlemen, if you'd like to come up to the table, you can begin whenever you're ready. And thank you both for being here. Appreciate it.
Chair Harris, members of the committee, we thank you very much. Hope we are audible here with this microphone. Bob and I will move this back and forth here. It's our pleasure to be here with you today. I want to chat for just a moment or two about the Griffith Foundation for those who may be unfamiliar with us. We are here to help empower public policymakers. That undergirds all that we do. We do that by helping to promote a greater understanding of insurance and risk management, and we do that through unbiased education. Griffith is a 501c3. We're here to educate. We're not here to advocate. We're nonpartisan as well. And as we step back a pace or two, members of this committee are certainly familiar with this, but risk management and insurance plays a very important role in our country, right? Undergirding many aspects of our professional endeavors, our personal lives, and we believe that informed risk management is a catalyst for a more secure future. So that's what sort of drives what we do. We're here to help inform you all. Better informed public policymakers, we believe, are better equipped to make sound public policy decisions for those that they serve. A couple of things to point out very quickly for you. In addition to the kind of programming that we'll deliver for you today, we also make live webinar programs available. And on our website, you'll find on-demand content on a variety of issues, everything from the fundamentals of risk and insurance to discussion of emerging issues and or hot topics. All that we do, we offer on a complimentary basis. We're a foundation, so we would encourage you, if needed, to visit griffithfoundation.org. Avail yourselves of any resources there. And if you have need for perhaps a deep dive on a particular topic, want some balanced exploration on a hot topic, do not hesitate to reach out. We're here to serve, and we'll do what we can to assist. So that's a little bit about Griffith. As I noted, we're a 501c3, so I would be remiss if we did not share a slide with you letting you know that given our mission, our comments, our contributions to today's program will be unbiased. They will be purely educational in nature. With that, let me turn things over to Dr. Bob Klein. He's already been introduced. He is indeed a thought leader in risk and insurance, also a native Michigander, and it's always great to collaborate with Dr. Klein.
Thank you, Frank. Yes, I think I spoke to this committee a couple years ago, and as you know, I am a native Michigander. So even though I was at Georgia State, I'm back here in Michigan, living in East Lansing as a Spartan. Whether that's viewed as good or bad, I don't know. But anyway, so the objective today is to talk about life insurance, and I'll admit I'm not the world's biggest expert on life insurance, but I've done studies in it and I've taught it. So hopefully I can just do this kind of basic educational piece. So we'll start out with the first question: what is life insurance? Well, it's really a contract that can do a couple of things. All life insurance policies provide some form of death benefit, right? And what that means is that if the insured dies, then a beneficiary or beneficiaries receive a face amount of that policy. There are also some life insurance policies that have what's called a cash value or cash value accumulation savings component, but not all policies, and we'll talk about the differences. In my view, I think replacing at least a portion of the lost income of someone is a very important function of life insurance, and that's why probably most people buy it, okay? But there are policies that do have a cash value accumulation component, and so some people will use it for that purpose as well, for savings and investment. This chart shows a very simplified presentation of major types of life insurance. Term life is probably the one that most people are familiar with, right? And that just provides pure death protection for some specified period of time. It could be 1 year, 5 years, 20 years, or to some specified duration. There's no cash value accumulation. It does provide the maximum amount of death protection for a given premium, so it can be a very good thing for young families to have. Now, there's something called ordinary life, which is kind of an older form of life insurance that still exists. It's considered a permanent life insurance policy. I mean, you buy it and you hold it until the insured dies. It does have a death benefit, and it also has cash accumulation. But that cash accumulation is basically at what I would call a guaranteed crediting interest rate. So there's really no risk there for the insured in terms of how much that policy is going to accumulate over time. Now, there's something also called universal life, which some of you may know about or have encountered. And this is something which I'll explain a little more about, but this is a policy that was developed basically in the late 70s, early 80s, that provides more flexibility than ordinary life, potentially greater returns on cash accumulation, but there's also some greater risk associated with universal life policies. So let's talk about term life. So this is the kind of insurance that most people buy. When I was at Georgia State, I had a group term life policy through Georgia State. I was able to buy additional coverage at Georgia State, so a lot of people can get life insurance through their employer. But in addition, I bought a policy on the market for some additional term life, and it provides death protection, is what it does. If the insured dies during the course of the policy, when the policy is in effect, the beneficiaries get the face amount. If the insured does not die and the policy terminates, there's no cash value accumulation. The deal is done, right? But what's nice about term life is it's particularly good for, I used to teach this in my classes, young families. You've got young breadwinners, 30, 40 years old with young kids who are dependent upon, the incomes of their parents, their, even work at home spouses provide services, and that you can buy a lot of death protection if you're relatively young and you're in good health, okay? So for example, a 30-year-old male could buy $500,000 worth of term life protection for $18 a month, you know, one site I saw. So that can be very valuable. There is a term I use here called renewable, and what that means is that even if I buy a one-year renewable policy, I have to renew that every year, and the rate can go up as I get older, right? But the insurance company cannot turn me down because my health status has changed. So that renewability provision is very important. Now, whole life insurance is a form of permanent insurance, and there are various kinds. I've talked about ordinary life, and sometimes you'll see this advertised on TV, you know, Gerber Life or some of these other companies, where this is basically an older form of life insurance. You know, my parents bought ordinary life policies on me and my brothers, you know, paid a small face amount. There is cash accumulation at some point. You just pay the policy up and it just stays in effect until you need to use it. And if you know, the insurer doesn't die, then you eventually can cash it in and get most of that cash value back. Universal life, I'll explain a little bit about how universal life developed. The problem with ordinary life is that, well, one, I don't want to call it a problem, but that cash value accumulation aspect of it is expensive, okay? So for a young family that's looking purely for death protection, probably not the best kind of product, but for somebody else, maybe it is. But another problem that developed with ordinary life was, particularly when interest rates rose, in the 1970s and early 1980s, people were looking at what they were earning on their ordinary life policies, and it was way less than what they could earn if they'd taken those premiums and just invested in the stock market or mutual fund. So the industry developed universal life policies, where basically there's a lot more flexibility with respect to the premiums you pay in. Generally, there might be a floor guaranteed crediting rate, but depending on the investment experience of the insurer, you can get more than that. So what they were designed was, one, to provide more flexibility, and two, a higher rate of return on investment. So this became attractive to some people, and a lot of universal life policies were sold in the 1980s. Now, there are some issues with universal life. It's a complex kind of policy, right? And it has these variable components to it. And particularly what happened in the 1980s and early 1990s, and I was working for various people, and I was working for the NAIC and at that time, was that these policies were sold, represented with, the agents would show, the historical performance on these had been great because interest rates had been so high. Well, when interest rates started coming down, the performance of the policies wasn't as good. And people were surprised by that, and they thought they, were going to get these much higher returns, and they didn't. And that made some people unhappy, okay? So consequently, there were some big lawsuits, big class action lawsuits against some very reputable companies. That caught the attention of the regulators. And so the NAIC in the states ultimately passed some laws and regulations to deal with this issue so that these policies were more accurately represented. And they also dealt with what we call a suitability question, so that agents weren't causing people to get out of policies that were more suitable for them for a policy that would be less suitable, in cases where universal life would not be the most suitable policy for them. I'm listing here some important contract provisions. If you have questions about any of these, I can try to explain it. There's always, inevitably some people ask things about different things. I'm going to just talk about a couple because, they always come up. Everybody always asks about the suicide clause, right? What that says basically is that if I'm an insured and I buy a life insurance policy on myself, right, that if I commit suicide within a year or two of buying that policy, then it won't pay out. But after a year or two, it will pay out. And that's just basically to deal with a moral hazard issue that, you know, people aren't contemplating suicide and they buy life insurance policies to, you know, to take advantage of that. Another important thing is what's called a non-forfeiture option, okay? Now, when you have a whole life policy that has cash accumulation, right, and you would be typically getting a monthly report or could see that cash accumulating, right? If you were to terminate that policy, you're not going to get all that cash value right away, okay? What happens is that over time, you become entitled to a greater portion of that cash value. So let's say I take out some kind of whole life policy. It's intended to be, you know, as I said, a permanent policy, you know, until I die or it's fully paid up. If I try to terminate that after 5 or 10 years, I'm not going to get a lot of that cash value out. But after 20 or 30 years, I may get most, if not all of it out, okay? So that can be an important aspect of understanding what you have and what you can do. Maybe one other thing I'll mention here is policy loans, okay? So you have cash value in that policy, you need money for something, you can actually get a loan on that cash value. You have to pay an interest rate, but it might be a more attractive alternative to you than, you know, other forms of financing, okay? But there's a bunch of other things I could talk about here, but I'm going to move on, okay? So now we're going to talk about annuities. You know, he's talking about life insurance. Well, there's a kind of a corollary with annuity. An annuity is actually a sort of life insurance in reverse in some sense. What an annuity does, basically, it pays out a steady stream of income over some period of time, okay? And it can be for some specified number of years, 10, 15, 20 years, or for some specified duration. And an example of that would be I can buy an annuity that pays me a stream of income until I die, or pays my wife and I until both of us die, okay? Now, what's attractive about that type of annuity is that, as you're aware, most people today have maybe some type of 401k retirement plan, but the old-fashioned defined benefit plan, pension plan, you know, where you got a monthly payment, most people don't have that anymore, right? Well, with this type of annuity, you can actually create your own kind of defined benefit pension plan. And that's attractive to some people because they want that certainty, right, of knowing that they're going to get that monthly payment. And if it's specified for a number of years, they can get it that way. Or if they're only concerned about getting that payment when they're alive, when they need the money, they can do it that way. So that can be very attractive. But again, with life insurance, there's various types of annuities, immediate versus deferred, variable versus fixed, all kinds of things. There is, in my view, you know, some downsides to annuities. One of them is they do come with expense loads. I mean, you know, an insurer is not going to issue an annuity without being able to, one, be compensated for the risk they undertake, right? And the policy has to be serviced. So I personally do not own an annuity, but I know a lot of people that do. So I don't say to someone, you should or should not have an annuity. Just understand, what is your goals? What do you want? What are your trade-offs? So there are definitely some very good things about annuities, and for some people, they make a lot of sense, okay? Regulation of life insurance. So I kind of dividing this between two basic areas: solvency regulation and what I call market regulation. And as I'm sure all of you know, insurance companies in the state of Michigan, just like in every other state, are closely regulated for solvency, financial condition, financial risk. That means that, like property casualty companies, life insurance companies need to meet a number of standards in terms of conducting their financial affairs, in terms of their financial structure, the risks they undertake. The regulators are in charge with enforcing those laws and regulations, and they're they're charged with monitoring insurance companies to make sure that their risk doesn't get too high or that they don't get into financial trouble. If they do get into some financial difficulty, then the regulators have the authority to take some action with a company, whether it's to conserve it, rehabilitate it, liquidate it, sell it, whatever. Okay? And there's also something called the Guarantee Association, which I'm thinking probably most of you have heard about. So what happens if your insurance company becomes insolvent, right? You've got a life insurance policy with a company, and maybe you have some cash value accumulated or there's a claim pending, and the company becomes insolvent. What happens? Well, a Guarantee Association is in Michigan, just like every other state, that will cover that insolvent insurer's obligations up to certain amounts, and it just depends on the item as to what it is. So in Michigan, for example, the maximum cash value that the Guarantee Association will cover is $100,000. So you have $100,000 of coverage through the Guarantee Association, but more than that you would lose if your life insurer became insolvent. Okay? Now the other area of regulation is what I call market regulation, and most importantly, life insurance products, as I would call them, policies, have to be approved by the insurance regulators in order for them to be sold in the marketplace. So in that process, the regulator determines, that they're fair, they're reasonably comprehensible, and that the pricing, generally makes sense. Regulators also regulate the conduct of life insurers, as well as obviously producers and agents. So that would come to things like marketing, underwriting, and claims handling. Okay? So if an insurer, clearly is in violation of laws or regulations in any of those areas, then that's another area where regulators would take action. And if a person has a problem with their insurer, obviously, then they might contact the insurance department to see if they can help. What insurance regulators typically will not do is get involved in disputes over facts, okay? But they will get involved in disputes over whether, the company is, complying with the law. The other point I would want to make about regulation is that I see it more of regulators policing or going after bad actors as opposed to, subjecting the entire industry to, I don't want to give the impression, that life insurers, just like other insurers, are always engaged in all kinds of nefarious activities. That's not the case. It really is in my view, regulation is to level the playing field and make sure everybody's playing fair. So oftentimes the regulators are really focused on finding the bad actors and doing something about them. Occasionally a good company does something wrong or makes a mistake, but it's more the bad actors you have to be concerned about in keeping the level playing field. Some issues with life insurance. Again, I have opinions. They not be shared with it by everyone, and I don't feel particular need to tell you what I think about these things, keeping in mind Frank's admonition to, for me to, keep this strictly objective. There are what I call some low-value, high-expense life insurance policies sold out there. I don't happen to be a big fan of them. Burial life, credit life, but these products exist. Some people find them useful, and for the most part, regulators have allowed them to exist. So there's got to be some reason for that. Another issue that can come up, not necessarily very often, but it can happen, so this is something regulators are on the watch for. If someone knowingly provides this false information on a life insurance application, for example, they ask you if you have cancer or have had cancer, and I have cancer or have had cancer, but I say no, and I know that's wrong, right? Then that could be for the purpose of voiding that policy, right? Well, the problem can be is if the company might know or suspect I'm being untruthful, but still collects my premium as long as I'm alive, and then waits to see if I file a claim, and then if I file a claim, void the policy. That really is not playing fair. So that leads us to what they call the incontestable clause. So a company basically, with some exceptions, has about a year to figure out if I misrepresented myself on an application, and after that, they can't void a policy. Another issue is what I would call sort of misunderstanding of complex insurance policies. Universal life is a very good example where it can be a great product, but people may not understand how the variable components work, and they may have different expectations, than the insurance company when certain things develop. And I know this for a fact because I've been hired as an expert witness on cases involving disputes over universal life policies. I guess a point I would make is that I don't think that many of these issues or problems, or whatever you want to call them, have a regulatory solution per se. For example, I feel that there are probably people out there that should buy more life insurance than they currently have, or may not be making the best decisions about life insurance. But you can't regulate that per se. But what we can do is try to make sure that people are better informed about life insurance, just as other insurance products, so that they can make better decisions. And so I see a lot of this. I mean, I do think that regulators do have to enforce rules, but I also think there's a public information aspect to it. And I think with that, I've completed my presentation. I would listed some references here for you. I live just down the street. So anytime you'd like me to come back and talk with any of you, either publicly or confidentially, I'd be happy to do that. Thank you.
Thank you. You shouldn't have told us she lived so close.
Yeah, well.
We might bring you in for a lot.
Okay.
Well, thank you both for being here. And, again, this is an area that I don't think people are, as you said, well informed about. So I think it's important that, at least committee-wise, we're all on the same page, and hopefully there's some people watching as well that may have benefited from the information. And I bless you for bringing up universal life. I actually have an issue with a constituent right now. Didn't understand how universal life worked, and to be honest, I didn't either.
Right.
So it's it's been a learning process for both of us, and Diffs has stepped in and helped explain a lot. So thankful for you guys that are experts in this. With that, do we have any questions on the committee, Madam Vice Chair?
Hi.
Chair, and thank you for your presentation. It's very important to me, being the chair of life insurance for NCOIL. The question I wanted to ask is, financial literacy is very important to me, and getting people, especially young people, to understand the benefits of getting either a term life or whole life, universal life, just life insurance in general. When we're young, we don't feel we're going to ever die. But if they get insurance when they're in their 20s, it's affordable. When you get them when you're in their 60s, it's just shocking. It's a shock. So my question is, how can we incorporate financial literacy to the point to get everyone to understand the benefit of either having a life insurance policy or an annuity?
Well, it's an excellent question. I mean, there are a lot of information sources out there, and just in the newspaper or just in social media, you'll see a lot of links to things where people can get informed, but they have to kind of initiate that effort. To be honest with you, I've thought about this, and you probably know this better than I, but I don't know what requirements, if any, there are for financial literacy classes in high school. Okay, but if I were in charge of the world, I would have every high school senior take some type of class on financial stuff. which would include insurance, but also savings, investment, banking, et cetera, and learn about these things. Because to be frank, with you, when I taught insurance at Georgia State, some of my students were insurance majors, some weren't, but there was not a lot of necessarily knowledge about insurance. So, and then those were college students, taking insurance courses. So, it doesn't surprise me that a lot of people don't really understand this very well, and anything we can do, whether it's through our educational systems or other means to make them aware of how insurance works and why it's important, would be great.
I just attended an AI conference in Chicago where they started to talk about artificial intelligence as it pertains to insurance guardrails, especially in life insurance. Are you familiar with how AI influences insurance? And if so, can you expound on that a little bit? What are some of the things you're looking at as potential guardrails to, you mentioned you were with NAIC, which is regulatory, some of the things that may be happening there that can, I guess, put more consumer protections into insurance as it pertains to AI.
Good question. I personally had not done so recently. I'm sort of a little bit pre-AI, in terms of my regulatory work, but I'm sort of aware of, sort of what was building to that. And actually, Frank and I had a discussion about that this morning, so he may be able to speak to that a little bit. But I think that AI is here. It makes sense for insurers to try to use that as effectively as possible for whether it's purposes of pricing, underwriting, or whatever. But then there's, of course, this other side of it, where there's the interest of legislators and regulators to make sure that, that laws are still complied with and public policy objectives are met. So that is potentially an area that, needs attention. How is that going to be accomplished? And I don't know, Frank, you want to speak to that at all or not, but
Yeah, so I would just say, Madam Vice Chair, as Bob suggested, right, this is while AI in many respects is new, although the reality is certain types of AI have been in use for many years, really we're back to that age-old tension, right, between encouraging innovation for the benefit of the citizens, right, in our various states on one hand, and doing so while we ensure that we have proper protections in place, right? That's an ever-present tension when we think about risk and insurance issues. And I think one of the challenges is understanding AI applications can be challenging, right? Talking about sophisticated mathematical algorithms happening in a black box, right, as it were. And part of the beauty, right, of that technology is that this black box activity need not be understood by all, right? It's a way to bring efficiency. Having said that, folks who are concerned with consumer protection do have a duty to at least at a certain level understand what's happening in that black box, right? Or at least to vet processes and constructs that might be in place. And so I know the NAIC is studying that and thinking about that. My sense is that sort of broadly, I think we'll find some equilibrium there, right? My sense is that both the industry, consumers, the regulatory community want to find some common ground there, and I think we'll get there. I don't know if that's helpful for you.
No, it's extremely helpful because it's the direction that the conference went. Thank you so much.
Indeed. Mr. Chair, if I may, you talked a little bit earlier, Representative Carter, about financial literacy and had asked Dr. Klein a bit about potential opportunities there. And just one item I might share with you, there are a number of jurisdictions that do require financial literacy programming in their secondary education systems in their states. So if it's of help to you, I'd be happy to drop you a note offline on that front, because there are a couple of states that They incorporate risk and insurance along with other components there. So happy to share that with you.
Any other questions from the committee? Rep. Leitner, do you have anything?
I'm good.
No? All right. Well, apparently, we don't have anything else missing. Rep. Fitzgerald, normally you have great insurance questions. All right. Well, thank you both for being here. I really appreciate it. And, yeah, we'll be sure to look you up in the near future for some questions. So, with that, apparently we need to talk about vision insurance next because I looked past my cards to read in. So I'm going to read these in for the bill that we previously talked about. So House Bill 4464, we have does not wish to speak and supports the bill, Mary Pollock from Michigan State Employee Retirees Association. Does not wish to speak but supports the bill, Scott Kempa from the Michigan Association of Health Plans. Does not wish to speak and supports the bill, Rory Lafferty from HAP. Does not wish to speak, supports the bill, John Shiflett from Priority Health. Does not wish to speak and supports the bill, Madeline Watts from McLaren Health Plan. And does not wish to speak and is neutral on the bill, Jenny Geis from DIFS. So, believe that takes care of that. And can I have a motion to excuse absent members? Rep. Carter, thank you very much. Without objection, absent members are excused. And with no further business before the committee, we are adjourned.